probably plan for your vacations better than you do for your retirement future. Welcome to the Financial Concerns for Retirement segment of our show. My name is Huda Hassan Duri, the founder of eChoiceInsurance.com. This is our first airing, and as such, we will present to you what we feel is the most pressing concern for your retirement portfolio. We will share with you today how to secure your retirement future by minimizing risk to effectively managing your overall financial portfolio even after death. Our focus is on your need for safety, guarantee, and tax control. The topics I'll be covering today will fall under the category of what you don't know can hurt you. And I have to give you a legal disclaimer that this is not legal or tax advice, nor an offer for sale of any specific product. It is our intention in bringing you this information to leave you empowered to take control of your future. As you can see here, the money cycle is dictated by age. There are 3 stages to the money cycle. An accumulation stage, basically you want to save as much as you can while you're generating income. And preservation stage, you basically don't want to lose what you just saved. And distribution, you want to effectively distribute it while having the tax consequences and to your heirs as well. Now, can you increase your income without decreasing the safety of your investments? As Wayne Dyer will say, when you change the way you look at things, the way you look at change. I wouldn't ask the question unless the answer was yes, so of course you can. You could use fixed tax deferred accounts for safety, guarantees, and tax planning. But you might say the interest income earned on your checking accounts, saving accounts, your CDs, and even stock mutual funds, bond mutual funds, and so forth are all taxable by the federal and possibly state governments each year when interest is credited. You will not pay taxes on tax deferred vehicles until you take out the interest, and these include 457 deferred comp plans, pensions, 401k, traditional IRAs, Series EE bonds, as well as annuities. Today I'll be discussing with you about annuities, but keep in mind there are 3 types of annuities. There is a variable annuity, there is a fixed annuity, and there's fixed index annuity. I will not be talking about the variable annuities where there is a chance that you can lose money on it. And there's also tax advantage accounts like the muni bonds. Loans from most permanent life insurance is tax-free, as well as Roth IRA. And keep in mind as I go through this that if you're not happy with the way that your account is performing, you can't take money out from one tax deferred account to another without paying taxes on it. And some of you might think 457 deferred comp accounts, you can't take it out, you've got to leave it there. Well, if you're not happy with the way it's performing, you can move the money into another deferred account. So why does tax deferral works? Basically, unlike a taxable investment, the earnings from a tax deferred investment grows or compounds untaxed until you withdraw it out. You basically get income on your principal, you get income on your interest, and you get income on your taxes that you would have been paying over a period of time that is in deferral. Let's say, for example, what happens if you let the money grow in deferral over a 20-year period. For example, you have $100,000 and you're at 28% tax bracket and growing at for 20 years, growing at a 5% interest rate. As you can see from this chart here, at the end of the term, at the end of 20 years, the value of your account would be $265,000. That is, if it's growing in a tax-free environment, that's how much money you could take out. Can you think of a tax-free account where the money could actually grow at a fixed interest rate? We just mentioned that Roth IRAs, they're tax-free. And loans from most permanent life insurance, they're also tax-free. And so at the end of the term, you've got $265,000. If it's growing in a tax-deferred account, that money grows to $219,000. But guess what happens if you're paying taxes on this money over the 20-year period? You get almost $203,000. And so tax deferral is there, and it's there for advantage. And the higher interest return you get in a tax deferred account, the more money you will make for your retirement income. For those of you near or at retirement, interest income earned and credited on most financial products such as mutual funds, saving accounts, CDs, muni bonds. These could increase your taxes on Social Security income, and also your Medicare Part B premiums now depends on these financial vehicles. And there is a legal way to go about this. Products such as IRAs, annuities, Series EE bonds, and loans from life insurance, they are not used to calculate Medicare Part B premium increases and also on your Social Security taxation. So the fewer taxes will be paid if you're in a tax-deferred IRA kind of account, and more of the money will come to you. And in April 2002, the IRS made regulations simpler and better for your IRA money. You can now take the absolute minimum in your amount no matter what you took at 70.5, and also you could take more money anytime without a worry. Before, you used to get penalized for doing so. And you can annuitize for an increased lifetime no matter what you've done previously. And what we find to be the most pressing and important part of the new regulation is that you can now allow your beneficiary to be determined even after you die. What this means is that a beneficiary has a limited period of time governed by both the state and federal law to determine if they wish to keep the IRA or disclaim it to the contingent beneficiary. And what this does is allows your beneficiaries to stretch out the income and tax over their lifetime. And so it also gives your children a check with your name on it every month of their lifetime. Now let's take a look at these pictures as we discuss preservation of assets in terms of risk management. The first one with the $2,500 is relatively safe, but let's take a look at the other three. You've got a piggy bank was $20,000, and another was $170,000, and the third was $85,000. A friend gives you a call and says, one of these three piggy banks is going to go bellies up. Which one would you go get first? Of course, the 170. But the friend calls you back again and says, well, the odds is that 1 in 90, the $20,000 is going to go bellies up. And the one with $170,000 has a 1 in 1,200 chance of going bellies up. But the one with the $85,000 has 7 in 10 chance of going bellies up. That's 70%. Now, which one would you go and grab first? Of course, the one with $85,000. Now, the first piggy bank represents a checking account. That's the average checking account. And that's typically insured by FDIC, and it's not a significant amount compared to the rest. The second one, everyone buys car insurance nowadays because it's the law, that the typical auto costs. And the third, $170,000, represents the average cost of a house. And the fourth is the long-term care expense cost.